Hope you're doing well. What a day, right? We are witnessing one of the biggest economic disasters in history play out. And I'm not talking about the correction in the stock market that we're witnessing today. No, this is going to go much, much deeper than that. That is the truth. Let's get into it because we got a lot to cover today. What should we start with? Let's talk about the economy, right? This economy that we've been told by the administration, by the political elites, the greatest economy in history, right? Strongest U.S. economy we've ever had. Well, today we got the non-farm payroll report, up 114,000 jobs added. That was against expectations of 175,000. Last month it was 206, right? So there's your strongest economy in history, skyrocketing unemployment rate, crumbling jobs. Keep in mind, these are the government numbers too, right? So the situation on the ground is probably far worse than is being reported. And, this is from Zero Hedge. They got some great graphics to kind of outline this for you. But not only was the jobs number this morning a huge miss, confirming that we are in a economic decline, in a recession, a big one. Also, 5 out of the 6 past reports have been revised lower. So this month's jobs are abysmal. The past 6 months' jobs were all fake anyway. Those numbers were all cooked. I'm sure this month won't get revised lower, right? And today, stocks indeed are taking a big hit. Now, I think everybody's kind of focused on this, calling it, big stock market crash potentially. Let's take a look at the markets. We've got the Dow down 2%, the NASDAQ down 2.9%, the Russell 2000 down almost 4%. Crude oil plummeting. Even gold is not getting off the hook today, down to around 24.58. I think that's the December futures contract, but gold is being pretty resilient. Silver back down to 28.12. I mean, yeah, I see someone in the chat there saying silver's frustrating. Well, it's certainly been a wild ride. It's been very volatile, and you can expect more volatility moving forward. But, silver to me, the fact that it's down today, I mean, it's incredibly fortuitous for stackers, right? Who can now get some metal at a discount. Now, look, what's coming, we have to worry about. It's not, a minor correction in the stock market, and this is a correction in the stock market. I mean, we've seen nothing but record high after record high after record high. Of course, you're going to have to give something back at some point, right? And now that a recession is confirmed, that's a good time to do that. But look, the stock market, these paper assets, they're likely going to head higher. Gold and silver is going to head higher. Everything is going to head higher in dollar terms. I mean, just look at this. This is the CME FedWatch tool. Following today's jobs report, expectations of rate cuts have absolutely exploded. Markets are now factoring in potentially 4 rate cuts this year. If you look at the probability of rate cuts at the September meeting, now the majority are expecting at least a 50 basis point rate cut, 80.5% chance of a 50 basis point rate cut. This number absolutely shot up following this week jobs report, and rightfully so, because what we are on the verge of here is the biggest round of money printing probably in human history. And that's the real disaster, right? It's the debasement of the currency, the inflation of these enormous asset bubbles, and we've got some other stuff to talk about. We'll talk about the debt. I mean, the debt is absolutely exploding. But before we do that, I want to give you another sign that we are on the cusp of a financial crisis, an economic crisis, and we're seeing that actually in the physical bullion market. So to do that, I want to go over to today's video sponsor, SD Bullion, and look at the price of junk silver. This has risen to $217.10 for a $10 face value roll of junk silver. Still a good deal, if you ask me, because I think these premiums are going to head much higher. But This is represents about a 6% markup over the spot price of silver. Now, just a couple days ago, we were looking at those numbers, and the premiums on junk silver was about 3% over spot. So that premium has doubled in the past couple of days. And junk silver is one of these things. It's like a canary in the coal mine, right? There's very little of it out there. A lot of it was minted, but he stopped minting it about 60 years ago. A lot of it has been melted down since that time. And now, whenever we get these financial crises, like in March of 2023, last year when the bank started to fail, you saw premiums on junk silver explode. So the fact that they just doubled over the past couple of days, it's a sign of where we're headed, and it's to a massive crisis. And that's why the Fed now is going to have to print huge sums of money. Why they're going to have to get in the markets, may already be getting into the markets. I mean, if you look at the yield on the U.S. 10-year Treasury, it's coming down quite a bit over the past couple of days at a very, very brisk pace. I want to look at the chart here and just show you. I mean, it's like falling off a cliff, basically, the yield on the 10-year note, the benchmark U.S. Treasury. Now, who do you think is buying up all that debt? Yeah, maybe some institutions are buying it up in the anticipation of rate cuts, thinking, as the rate goes down, the value of the higher yielding bonds goes up. So that could attract some buying interest. But I suspect that we're witnessing some intervention in these markets on the part of the Fed, and it's just getting started. If you look at the CME FedWatch 12, I want to cover this one more screen here. If we go to the anticipation of what's going to happen by December, the December FOMC meeting, you have now got the potential for 4-5 rate cuts now being priced in. This right here, 37% chance that the target rate will be at 425 to 450. That would represent a full 100 basis points of cuts by then. And markets actually think that maybe even more cuts, down to 400 to 425 basis points, is the more likely scenario by December. So, I mean, this is just incredible. Now, if you want to know the real reason that they've got to cut, it's because the banking system is on the verge of a major crisis. Again, you see the increase in premiums on junk silver. We know that that is indicative of problems in the banking system. And the reason is because people, when they start to see how much a house of cards our economy is, they want to get into physical, tangible assets. Junk silver being one that they can't mint more of, so its premiums are more susceptible to fluctuations just because of the limited supply. So you can expect the premiums on junk silver moving forward, I think, to continue to disconnect from the paper price of silver. But I think the paper price of silver is headed higher as well. Same with gold. I mean, gold is right around record highs. It has corrected a little bit today, but earlier in the session, it was sitting over 2,500 for a nice little chunk of time. That is, I think, a preview of what we have coming. But look at the U.S. national debt. Look at this. $35.124 trillion. Remember, just the other day on a live stream, we kind of covered that we had just crossed the 35 trillion mark. Now 35.124. That didn't take long, did it? Less than a week. And if we go to the U.S. Treasury debt to the penny website, this gives you daily updates on the amount of U.S. debt. So this is definitely a nice resource provided by the Treasury. And we scroll down just the past couple days. You can see most recent data from July 31st, where we're at 34.1 trillion. So we put on another 20 billion since then in the past day or two. But I mean, look, it was on the 26th of July that we first hit 35 trillion in debt. And now we're already at 35.124. So $124 billion in debt in a week, essentially. And that pace is not going to slow. If, the Fed needs to get in here and intervene, and that is why the possibility of rate cuts has shot up. If this market correction continues, you may very well see the Fed have some kind of emergency intervention. I mean, it probably won't be rate cuts. Maybe they'll get in and announce an end to QT, and they'll start buying up U.S. debt again. Again, I think that they may already be doing that. You see the yield on U.S. Treasuries declining. But, I mean, to give you an idea of how hard markets are being hit given the news of this recession, I mean, look at Intel. Intel's price down 27% at the moment. I think it was down up to 30% at the lows of the days. So, markets are getting hit here. The possibility of a recession, slowing earnings for these tech companies, it's not good. And the Fed is in the business of inflating. Now, as everybody sees their 401ks, their paper wealth evaporating, it gives the Fed the cover it needs to begin printing again. We've heard a lot at recent FOMC conferences, press conferences with Jerome Powell, where he talks about uh, the dual mandate, right, which is to protect the job market and to protect price stability. Now, the whole thing's a joke. I mean, price stability would mean, prices staying the same. The Fed says they want to debase the currency by 2% annually. They want to see 2% inflation. So, they do great with that mandate. But he's talked about dual risks and how now the job market may be a bigger concern than inflation. And certainly with today's crushing job numbers, absolutely abysmal, plummeting non-farm payroll report, that is going to give the Fed all the cover it needs to begin printing once again. And, the Fed has one tool, right? The printing press. It's all they can do. They can lower rates, they can raise rates, they can get into the market and intervene directly, like with QE. What we saw in the great financial crisis, what we saw in the pandemic economic crisis, the government created crisis. And that is what we are going to see more of. But, it's going to be on a level that we have never witnessed before, because that is the nature of these interventions, right? They always have to be bigger than the one before, because the crises are that much bigger because they've just been papered over. Do me a favor. We're at 196 people in the live stream, 39 thumbs up. Smash that like button if you want to support the channel, and consider subscribing if you haven't done that yet, because this really is just getting started, and there's going to be a lot of interesting news to cover in the coming months and years as this slow motion train wreck, which is now accelerating to a kind of a normal speed, plays out before our eyes. This is the Fed balance sheet. I mean, QT, right? That's like this little blip from what, almost 9 trillion down to where we're at 7 point something. This is never going to get down to pre-financial crisis levels, right? When they were first started QE, that's the Federal Reserve intervening in the debt market, buying up government debt, creating money out of nowhere, keeping interest rates artificially low, allowing everybody to borrow, huge sums of money because those treasuries are the benchmark. When they started this, Ben Bernanke, the chairman of the Federal Reserve at the time, he said that it wasn't debt monetization and that they would normalize the balance sheet once, everything got under control, but they never did, right? It was a decade plus of QE. They just kept expanding the balance sheet. Now, they tried to begin tapering it here. I think that was in about 2018, and they didn't get very far. This was actually pre-pandemic that they had to reverse that because the overnight lending mechanism at the Fed started to break. But then conveniently, immediately following that, they got the pandemic an excuse to print huge sums of money, trillions and trillions of dollars injected into the system, building up, creating one of the biggest asset bubbles in history, which we continue to be in the midst of, by the way. That's not done. And it's about to get a lot bigger. Now, then they did, again, the kind of slow motion QE for several years. Whoops, inflation started to run out of control. Even according to the official numbers, it was, 9% at the peak, much higher than that when you look at it in actual debasement against, real goods and services. And we've got this much retracement. That spike there was back in the great financial crisis. Yeah, I see Gypsy Tree in the chat here saying silver getting whacked. Okay, we'll talk about that in a moment. But this number, I mean, this is going to skyrocket higher. This is just the beginning of the next financial crisis. As this market sell-off maybe accelerates, continues, and it will until the taps of easy money get turned back on. Now, let's talk about silver. I mean, the silver chart is actually still very bullish. Now, could it go lower? Sure, the paper price of silver could go lower. I think if that happens in the midst of a financial crisis, though, what you're going to see is physical silver will actually probably remain untouched. And what's going to end up happening is the premiums on physical metal will just rise to compensate for any decline in the spot price. Now, I think there's also the possibility the spot price could just take off from here. I mean, if you look at the chart, it's a pretty bullish setup, but For those who are skeptical, like Gypsy Tree there, and I know this is somebody who leaves a lot of comments on the videos, always something negative. Some people I think just like to be miserable. But look, don't get into physical silver. Go sell it. A lot of people are selling it right now. If you're concerned, I mean, guaranteed, unless you bought at like the very highs of the silver squeeze, you're in the green on this stuff. It's at the highest level in many years. If you look back 5 years, silver's up something like close to 100%, I think the spot price. So, yeah, I mean, I do view physical silver especially as a safe haven, but it's not like these other financial assets. The thing about physical metal is you keep it in your custody. So, when you understand that the entire financial system, without additional easy money from the Federal Reserve, would probably be collapsing right now. How much do you want to be in digital assets? How much do you want to be in paper assets? Certainly, there's a place for that, and I actually think that a lot of these assets, the Nasdaq, the S&P 500, they're probably headed higher in the near future because the Fed is going to start printing huge sums of money. I mean, what happened last time? The Fed began intervening in the markets. It inflated the bubble that we're in the midst of now, and we're right around the corner from this number, the Fed balance sheet, moving much higher. Unofficially, again, it probably already is. That's why we're seeing a major decline in U.S. Treasury yields right now. Someone's buying it, right? Is it the banks? Yeah, they're probably buying some, but I don't think they're buying enough to cause the kind of moves that we're seeing. So it's possible that we are, seeing some stealth Fed intervention already. And this is a global phenomenon, right? This isn't relegated to the U.S. Today, the Japanese stock market had its biggest sell-off since I think 1987. So central banks around the world are about to, in a coordinated way, unleash a massive surge of liquidity. Now, what does that mean for inflation? Well, it means inflation's going much higher, right? And you may begin to see gold is already kind of functioning as a inflation hedge, but you may begin to see silver fulfilling its role as an inflation hedge as well. Now, it will be a bumpy ride, right? You got to keep in mind, silver is not really a uh, investment or an asset for the faint of heart. And I actually had some comments recently on a video that I wanted to mention because somebody said that they feel like gold is actually safer than silver. And none of this is financial advice, of course, but I will tell you that, I mean, my assessment is that you are correct. Gold is a safe haven asset than silver. It's the sure thing. It is still considered a tier one asset by central banks. Central banks don't stack silver, at least as far as I know. Some of them probably have some stockpiles somewhere, but it's not on the official register of assets. But gold, central banks have been buying this stuff up at the fastest pace on record because they know what's coming. By the way, when it comes to inflation and debasement of central bank digital fiat currencies. Now, listen, if anybody knows what's coming for the fiat currencies around the world, it's the central banks, right? Because they're the ones who issue them. They're the ones who set the interest rates. So when you see central banks around the world stocking up on gold, you might want to follow suit, right? And get some. And look, I like both precious metals, but gold really is more of the safe haven asset. Now, silver has an aspect of that. It still has thousands of years of history as a monetary metal, right? Even if it's not really fulfilling that role right now in the global economy, just because silver has been demonetized for the past, 50 or 60 years, that doesn't mean that it's not money. It just means that, there's a lot of room for it to move higher when it gets recognized once again for its monetary properties. But the thing about silver is that it runs a lot faster than gold under the right circumstances. And the right circumstances for silver would be the biggest episode of fiat money creation in the history of the world, which is what we're on the precipice of. So, that's why I'm still stacking. I stack both metals. I have a diverse stack of physical metals. I've got, fun stuff like this, these little 1 ounce poured bars. These are kind of collectible. Will I ever get, a premium over spot for those? I don't know, maybe under the right circumstances. I've got a lot of junk silver. This is probably my favorite number one thing to stack. And even if you see the spot price of silver languish, I think you're going to see junk silver move much higher. We've already seen the premiums on junk silver, as we covered just a few minutes ago, double from about 3% over spot to about 6% over spot, indicating that we are on the verge of a financial crisis. And when demand picks up for physical assets, which It's starting to with today. I think people are getting the memo here that things aren't okay in this economy. Well, you could see the price of junk silver just explode even while the spot price of silver languishes. I also like goldbacks, give them a shout out. Real tangible money. Look, if you like the idea of sound money, the goldbacks are used in 5 states as legal tender. They're worth, I think, supporting, even if you don't necessarily want to add them to your stack. And I will say this, a lot of people talk poorly about goldbacks. They're a very highly polarizing thing. Some people love them. Some people actually use them and spend them. But a lot of stackers kind of poo-poo them because of the high premiums, etc. But I will point out that the goldbacks, if you look at depending on the time frame, have actually outperformed silver because these things are tied to the price of gold, and gold is, of course, near record all-time highs. So, it pays to have a diverse stack, I think. But at the end of the day, any physical metal, it doesn't matter what you're getting. Fractional gold, gold backs, silver bars, silver coins. If you want to get some like vintage silver bars to have some kind of collectible asset mixed in there, the pre 1933 gold coins, those are on like, bargain basement price sales right now. The premiums on those are the lowest I've ever seen. SD Bullion has those pre 1933 $20 coins for like 2.5% over spot, which is just incredible. But that's all going to change, right? Once people start realizing what they're in for here, which is just vast money creation, which is right around the corner, I think the interest in physical assets is going to become much higher. That's just my take, not 100% sure that that's going to be the case, but that is my assessment of the situation. And again, all of these assets are likely to be heading much higher because the value of the dollar is going to diminish. The US dollar index, is getting hit pretty hard today, too, last time I looked. A lot of people think that a recession will be good for the dollar, but the reality is that when you print vast sums of dollars and the buyers of dollars, the use of dollars around the world is diminishing as a result of its weaponization and de-dollarization, it means the value is going to go down and hard assets are going to go up. Now, let's talk a little bit about geopolitical news too, because this weekend, I mean, this could be a crazy weekend, right? We're on the verge of a major economic crisis. Recession is confirmed. Stocks are getting hammered. Assets across the board selling off. Yes, gold is hanging in there a little better than others, but even it is in the red today. And yet, at the same time, we're on the verge of a major war, a war in the Middle East, which could spread globally. This is the latest from Bloomberg. Biden promises Netanyahu new U.S. defensive military employments. So, deployments, not employment. I'm getting the employment numbers mixed up in my head here and conflating words. But yeah, new U.S. defensive military deployments in the Middle East. President Joe Biden promised that he would add these deployments as Israel faces fresh threats to avenge assassinations of Hamas and Hezbollah leaders. Let me know in the chat. You think we should be sending fresh U.S. troops to the Middle East? Put a 1 if you think that's a good idea. Put a 2 if you think that that is probably not wise, especially given the fact that we have no money. We're bankrupt. They seem to neglect this when they come up with these military plans, like instigating a war with Iran. But according to this report here, Biden reaffirmed his commitment to Israel's security against all threats from Iran, including its proxy terrorist groups Hamas, Hezbollah, and the Houthis. The president discussed efforts to support Israel's defense against threats, including against ballistic missiles and drones, to include new defensive U.S. military deployments. At the same time, though, they're saying here, I mean, this is so funny. I mean, it's not really funny. It's actually horrifying. But they also say that you need to move forward with ceasefire efforts. So we're going to send over, this huge contingent of military forces. We're going to build a flotilla there. But we want you to move forward with ceasefire efforts. Never mind the fact that the head of Hamas, the political leader of Hamas, was just assassinated. So, I mean, who do you pursue ceasefire efforts with? I guess whoever, his junior cadre there of leadership in that organization. But maybe if you wanted to pursue a ceasefire, killing the leader who the negotiations had been ongoing with, not the best move if what you actually want is a ceasefire. So, they're paying some lip service to the idea of pursuing a policy of peace here, but all signs point towards major escalation in the conflict. And, if you want to see something that's going to escalate the stock market crash here, the recession, all you need is spiking energy prices. And we may see that this weekend. If Iran decides to launch another series of airstrikes at Israel, the best case scenario is that they use a couple of $1 million interceptors to shoot down these $50,000 drones. Of course, that's just going to get tacked onto the national debt. I mean, who knows, by the end of the weekend, maybe this will be 35.2 trillion, right? 35.3. I mean, why not? But worst case scenario, the attack is not the way it was back on April 13th, where, Iran tipped their hand and said, hey, we're going to launch all these interceptors to save some face. What if they actually want to do some damage? What if they can't rein in the Shiite militias, Hezbollah, their proxies in Iraq? What if the Houthis decide that they want to escalate things? I mean, this is all a huge risk, which, the degree to which the U.S. economy and the global economy are collapsing is reflected in the fact that as all of this plays out across the Middle East, the price of crude oil is down to $73, right? I mean, that tells you how bad the collapse is, that while we're on the verge of a major war in the Middle East, a major escalation there, you got the price of crude oil collapsing. What does that say about the U.S. economy? It shows you that a major slowdown is right around the corner. Now, as far as gold and silver goes, you actually could see, in that case, it makes me think about silver's role as an industrial metal. So you could see some additional weakness in silver as this economic slowdown continues. But again, this chart here, it's looking pretty bullish to me, just from a technical standpoint. Silver is trading within this channel. Despite the fact that we had this nasty economic news today, it didn't break down the way that you're seeing crude oil break down. So silver's safe haven status, I think, is beginning to weigh perhaps greater than its industrial role. But at the end of the day, whatever the spot price is, how many ounces of silver, paper silver, get traded to determine the spot price? It's something, hundreds to one against the physical metal that is underlying that paper silver contract. And the real reason we stack, look, you got to keep this in mind. The real reason that we stack the physical assets, it's nice when you see them go up, the paper price rise. Maybe you've got some miners, which are actually getting shellacked today, by the way. But maybe you have some miners, maybe you have some derivatives of silver that you see go up. That's always nice. But the real reason that we stack the physical stuff, like the kind you can hold in your hand, it's not to, get some kind of paper profit. I mean, if you do get a paper profit from it and the system doesn't collapse before you do that, great. But the reason is because all of this is unsustainable, right? You can't keep buying your own debt with your own central bank indefinitely. Now, we've pushed it pretty far, 7 point something trillion dollars. $7.17 trillion. Yeah, that's how much debt the central bank has bought from the U.S. Treasury. But this cannot go on forever. And eventually, this system, people will lose confidence in it, especially as you see de-dollarization expanding around the world. The foreign buyers of U.S. debt, they're actually buying U.S. debt. They have the highest amount on record, but the amount of the total debt held by foreign holders is declining because we are borrowing so much, right? And the only way that you can exist in that scenario where you keep borrowing more and more and more, and that's the only thing propping up the economy at this point, the $2 trillion of deficit spending getting pumped into it, the only way that you can continue doing that while you have a diminishing pool of buyers around the world, people who, nations rather, not people, but nations that no longer trust the dollar or are concerned about its weaponization. They might find themselves in the crosshairs of U.S. sanctions moving forward, such as China, the second largest holder of U.S. treasuries. As their interest in buying U.S. debt diminishes and the borrowing ramps up, the only way that you can keep interest rates from spiking due to a lack of buyers is you get the buyer and lender of last resort, the Federal Reserve. And look, we know the game plan. It's not a secret. I mean, there's no indication that they are going to treat this crisis differently than the previous ones. The only difference is that this crisis is going to be bigger because they always are, because it's the previous crisis plus all of the papering over, all of the malinvestment, all of the artificial money creation that has taken place since then, keeping these bubbles afloat. It means that the ultimate crisis is going to be that much worse. And that means that the amount of fiat required to be injected to bail the system out always goes up, and it goes up exponentially. So next time around, how many trillions is it going to be? I mean, 5 trillion, 6 trillion, 7 trillion. How much can you do it before things really break and people lose confidence? Well, we're going to find out. We're going to find out soon, I think. So let me know what you think in the comments down below about all the topics that we covered, where this economy is heading, what's going to happen over the weekend. Let me know what you think in the comments down below. It's certainly interesting times, although that can be a little scary. So anyway, stay safe and happy stacking, everybody. I will catch you next time. Smart Silver Stacker,